All right, folks. Today we have the absolute pleasure, what a blessing to hear from legendary investor and speculator. I love how you don't shy away from that, Rick. And I just got to say, man, it's an absolute honor to have you on the show here today. Only found you just last year at the Vancouver Resource Investment Conference. That was my first time up there. And you really blew me away. I was the most impressed with your presentations. I went to all of your workshops last year. And then once again this year, it was a pleasure to hear you speak again. I'm really looking forward to being able to connect with you. And we're going to talk about many topics that I'm interested to hear your opinion, how you're positioning yourself. Obviously, a lot of chaos in the markets these days as we try to find real value. And I think that you are someone who's time tested and very experienced in finding that value, particularly in the commodity space. We're interested in learning about that. But for those in the audience who don't know who Rick is, he is the former CEO of Sprott, and he is currently the founder of the Battle Bank. And really commend your effort there to disrupt the banking sector. We'll talk more about that later. And then everybody can find Rick at ruleinvestmentmedia.com. You are putting out content these days. I see you doing many interviews, and it's just an absolute honor to have you here today, Rick. Thank you for joining me.
Well, it's a pleasure. Thank you for having me on. I'm delighted that you liked the presentation in Vancouver, and I hope you like today as well.
Well, I was talking with Andy, and he described you as a wordsmith, and I thought that was the best description because your presentations were as slick as ever, but the value that you contained in them was impeccable. And I didn't even see you have any notes up there, just right off the top of your head. And so I could tell that you know your stuff, and then your track record speaks for itself. And so we got a lot to talk about. So I want to get into it. We're going to start talking about macro. And the first question is, are we witnessing the fall of the U.S. empire?
No,
Okay.
At least not in my lifetime.
Okay.
My friend Doug Casey famously says, the U.S. dollar is the worst currency in the world with the sole exception of every other currency. Or more colorfully, he says that the U.S. dollar is the prettiest mare at the slaughterhouse. But the truth is that we in the United States have the most liquid and the most transparent economy in the world. For all our faults, while the rest of the world doesn't trust us, they trust us more than they trust each other. And for those reasons, the US dollar will be the paramount reserve currency for the rest of my life. For the record, I'm a very healthy 71-year-old.
Yeah. Still looking incredible. Now, to that point, though, we are seeing the United States dollar lose its share, right? If you break up the pie of all the reserve currencies, we are losing a piece of that. And there's two aspects to this, right? Holding it as a store of value on the asset side, and then on the currency transaction settlement side. And we're seeing countries, even like our allies, France and Saudi Arabia, now doing deals outside the US dollar. So, okay, the empire is going to last a little bit longer, but what does this mean for the average American who's benefited off the privilege of that reserve currency status?
In the near term, nothing. You need to be concerned with the absolute deterioration of your purchasing power, not the relative decline of the purchasing power. During my duration at Sprott, I remember very well talking to some Asian sovereign wealth investors about gold and various products. And I remember asking them once, saying, as an American, it's lovely that we paint a bunch of promises on pieces of paper called treasury bills and we send them to you. And you send us stuff like cars and steel and computers. Seems like a good trade to me. How do you think of these as an investor? Because I sort of think of them as time bombs or long-term lies. And I remember my host looking at me and smiling and says, Rick, what you say is very true, but yours is a liquid, transparent lie. And although we don't trust each other, we trust you more than we trust each other. And I think Americans need to understand that. The difficulty that Americans have to face isn't the foreigner's perception of us. It's the reality that we're creating for ourselves. The on-balance sheet liabilities of the U.S. government exceed $34 trillion. That's the banks. But the off-balance sheet liabilities are worth. Your young viewers need to look at me, 71 years of age. Think Medicare, Medicaid, Social Security. The off-balance sheet liabilities of the U.S. government, Net present value exceeds $120 trillion. Add those two numbers together, it's $150 trillion, not including state and local problems. That debt is solved by a budget that is itself in deficit $2 trillion a year. For young people like you to understand the ills of the American economy, you just need to understand that the total amount of private assets, which will be passed on from my generation to your generation, is $150 trillion. And we've already spent it. The net present value of the obligations that we're passing on to you is also $150 trillion. We voted all kinds of cool stuff for ourselves, and we forgot to pay for it, and you get the bill. So your job is to figure out how to save yourself from our profligacy. When people understand that, when people come to understand that the problem isn't China, the problem isn't Russia, the problem isn't Iran, the problem isn't in the euro, the problem in the United States is the United States, then you'll be most of the way there in terms of engineering the architecture of the way you survive and thrive for the next 30 years.
And if we hold ourselves accountable, then we take control once again of our situation, you know. And so I really like what you said there. You know, I've heard you describe a bond as a certificate of guaranteed confiscation. Now, the Treasury's set to issue another 10 trillion of these suckers this year. Who's going to be the buyer?
I need to note that was actually Hayek. I stole it.
Oh, okay.
So don't attribute it to me, thank you, but it's not mine to attribute. What I mean by that is that almost certainly the U.S. Treasuries will be redeemed by the U.S. Treasury, and they'll be redeemed at par. The problem is that the spending power of what you get paid back in is going to be much less than the spending power that you spent to buy it. I fully expect the U.S. government to be able to sell all of these because confidence in the U.S. dollar remains strong, and the alternatives for most people and most countries are non-existent. The difficulty is not so much what happens over the next 2 years, but rather what happens over the next 10. Let me explain this to you. Most of your viewers and most thinkers, most congressmen, view inflation through the lens of the CPI, the Consumer Price Index. Those people believe that inflation is diminishing your purchasing power by about 2.7% compounded. I would suggest to you that the CPI isn't a cost of living index. I would argue that it's a manufactured index. In the first instance, it's hedonistically adjusted. They determine by some formula known to them the true economic value of the apartment you rent and the computer you buy, which is divorced from the price you paid. In addition, when it's inconvenient, it doesn't include food or fuel, which is useful to you only if you don't drive or eat. But most importantly, the CPI doesn't include tax, the single most important expense that most people face. I tried to backtest my own consumption of goods and services, and I learned, to the best of my ability to calculate it, that the purchasing power of my savings is declining at about 7% compounded. So the problem for the bondholders comes like this. If you buy a U.S. 10-year Treasury and they pay you 4% a year, they're paying that to you in a currency where the purchasing power is declining by 7% a year. In other words, the U.S. government is basically guaranteeing to cost you 3% of your purchasing power a year every year for 10 years, a promise that I believe they will pay.
Yeah.
They will keep. And what happens isn't so much in the near years. You don't notice that 3% deterioration in the near years, but years 5, 6, 7, never mind 17, you notice it in a major way. And I think that's what happens to the perception of value offered up by the US dollar and to alternatives, in my case, often gold.
Yeah. Yeah, Andy Schectman gave a presentation on the logarithmic decay of the US dollar, and it's slowly and then it's all of a sudden. And I've heard you mention about this benign period that we've had here in the U.S. economy from the late 80s till here recently. Can you explain that a little bit?
Yeah. The decade of the 70s was fairly tumultuous, and we could talk about that later if you like, in terms of past being prologue. But beginning really with the end of 1981, the Volcker years, when interest rates went very high and inflation and the perception of inflation was conquered. The period 1982 to 2022 was probably the most benign economic period in the history of humankind, particularly if you're an American. The American dollar was in the ascendancy. We had the ability to use seigniorage. In other words, we printed currency and sold them to other countries. They financed our idiocy. And our idiocy was profligate. Yeah. But with the dollar strong, interest rates declining, housing strong, employment for those who were employable strong, nobody noticed. Buy the dips was the mantra. The bond market went crazy because the prime interest rate fell from 17.5 to 4, making existing bonds more valuable. All that changed in 2022. The interest rate bottomed and started back up. You went from credit easing to the beginnings of credit contraction. When bond yields go up, the cost of capital goes up. The yields that are paid to savers on savings instrument goes up, and that makes existing dividend streams less valuable compared to savings, which hurts equity prices. So we've come into a period where the wind isn't in our sails. And I think increasingly, too, we come into a period where the wind, at least in certain circumstances, is in our face rather than in our sails. I myself lived through a period similar to this in the 1970s. The writing was on the wall for inflation beginning in 1968. You won't remember, but your father might. We fought the war in Vietnam, and we fought the war on poverty. By the way, we lost both. And the consequence of that is that we had a bunch of debts that we couldn't afford to repay. We had a choice between reneging, that is to say, ending Social Security and defaulting on our foreign bonds, or inflating away the net present value of the obligation. In the decade of the 70s, we chose the latter. Specifically, the purchasing power of the US dollar in the period 1970 to 1980 declined by 80%. And my suspicion is that what faces us over the next 10 years is something similar. Yeah. I believe myself that it's going to be less extreme because I believe that there are other economies in the world that will begin to do well. And the ascendancy of those economies will make America's sins less apparent. But I don't think you'll get through them well if you don't pay attention and start acting on your own behalf now.
Right. Yeah, and I'm excited to get into that as far as how you're positioning yourself. I'm glad that you brought up the CPI lie, as we like to call it, right? And this disconnect between Wall Street and Main Street that I think has really been exacerbated here lately with the stock market printing nothing but green candles, achieving all-time highs in all the major indexes. NVIDIA now worth more than the entire Chinese stock market. I mean, it's an upside down reality. And I wanted to ask, you mentioned the CPI and all this, and I think that, to your point, they strip out anything that matters. And you found that in your personal life, you're with your own math that, we're looking at about 7%. And even when you look at a trueflation, they say the aggregate inflation since 2020 is about 22%. And I've been doing the same thing where I just round up to 10%. Right? We might as well just skip round up to 10%. And then even on stuff that really matters, you're talking 20% plus from where we were pre-pandemic. So the aggregate compounding inflation just destroying the value. And once again, on the other end of the spectrum, this is why Wall Street's having itself a party again, right? Everybody's speculating that the Fed is going to achieve another soft landing. So I want to get to that in 1 second, but your thoughts on, are they just stupid or are they, just downright lying to us? Because now you got Paul Krugman, I call him talking head pundits like Paul Krugman, that want to strip out energy, food, shelter, used cars, everything that matters. And now they've come up with a new definition, the super core. What reality are we even living in anymore, Rick?
Well, you asked if they were stupid. No, they aren't. Well, are they stupid? I'll have to think about that. They're intelligent in their messaging. Yeah. But I think their messaging has a point. I think they're statist. I think specifically that whole ilk, Krugman, the World Economic Forum, all of them have a belief as to the way that you should live. And if you don't adopt that belief, they're going to do their level best over time to force you to adopt it. So that's a problem. Are they lying to us? Well, really only when their lips are moving. Um, I think you need to understand that. I think they see their job as changing the world's paradigm to the way that they think it ought to be.
Yeah.
But I think Americans are easy to lie to.
Yeah.
I think that most Americans, most people in the world, don't want to take control of their financial future.
Yeah.
That would cause them to be afraid, and it's more fun to not be afraid. Most people want to consign their financial future to the big brother. Most Americans 20 years younger than me want to believe that Social Security will be there for them when it's broke. Most Americans want to believe that your generation should pay my generation's medical bills because we didn't save to do it ourselves. Your generation may feel differently about that. And I think that people need, rather than to believe, to study for themselves. I'm not asking them to assume my belief structure. I'm not saying that for everybody who listens to you, that the purchasing power of the basket of goods and services that they consume is escalating at 7% compounded. I'm just asking them to ask themselves the question.
Yeah. Yeah. So let's get into this. Is Jerome Powell going to be able to, achieve the miracle? Because in the last 45 years, essentially, at the rate that they're going to be looking to cut rates, it's they raised them at the fastest pace in history. Now they're supposed to be cutting them. In the last 45 years, the only time they achieved that soft landing was 85, 86, which just gave the stock market a little bit more life before we got the 87 crash. So do you think that Powell's going to be able to land this plane?
I would argue that from his viewpoint, he has achieved a soft landing. I'm amazed at the strength of the U.S. economy after the increase in nominal interest rates. That goes really to the fundamental strength of the U.S. economy. We are, after all, an economy where 5 or 6 kids can commandeer a garage in Sunnyvale and out pops Google. This has nothing to do with our government and all to do with our individuals. And I'm delighted with the way that our individual creativity and tenacity has funded our communal stupidity.
Yeah.
I am with Battle Bank in front of the Fed right now. So I talk to lower level Fed officials. The senior officials don't deign to talk to an applicant like me. The lower level Fed officials, by the way, are uniformly interesting, polite, hardworking, well-meaning people. They believe to an employee that they are the last thing that stands between American society and inflation. They believe that Congress of either party will never cut spending. They believe that the presidential candidates won't cut spending. They believe that Americans politically have no interest in cutting spending either. What that means is that the Fed employees don't want to see interest rates cut. They don't want to see a pivot, and it will only be politics that forces them to do that. If you agree with that, if you think that they will get away with not cutting interest rates politically through 2024, my suspicion is that you will not see in 2024 a major deterioration in the bond market, the equity market, or an increase in the gold market, which is to say, you will see the inevitability of what I see occur over time, but it won't be imminent. I mean, the strength of the U.S. economy and the strength, the strength of confidence in this economy are amazing. In my little village, we have such a labor shortage that a young person who goes to work for Safeway gets paid $20 an hour to learn. Yeah. And you think, wow, that's a lot of money when the minimum wage is whatever it is. The truth is that $20 an hour in a community where the median rent is $2 per square foot per month means that even this high minimum wage or high starting wage, while it appears to be attractive, doesn't fund our lifestyle. And that's where the real rub comes in over the next 3 to 5 years.
Yeah, so for me, my thesis that I'm rolling with for this election cycle, right, over the next year, is that I just have a feeling that something's going to break. When I look across, I don't think that this banking crisis is over. And what I see from Janet, I call her Janet No Tellin' Yellen, and Fed Chair Powell, is kind of just shrug your shoulders. And if any more small regional banks go, as long as they're not systemically important, it's not a big deal. And so I kind of just see that we might have some moments here where something breaks, another bank goes down. Obviously, we had that New York community bank was crashing this last week. So do you think that the banking crisis is over? And my thesis is something breaks, and this gives the Fed the excuse to give us a cut. And if they have to, maybe turn back on the money printer. But I think that you're right in that they really believe that they've achieved that soft landing. By their manipulated data, one could argue that they have. But my thesis is something breaks this year, gives them the excuse to open up Powell's Pandora's box once again as we coast through the election. What do you see playing out here the rest of this year? And thoughts on the banking crisis?
Make no mistake, the Fed doesn't want to cut.
Yeah.
If Congress makes them cut, if the American people make them cut, they will cut.
Right.
We are not out of the weeds with the banking crisis. We still have more of the commercial mortgage crisis to go through.
Yeah.
I think we have a crisis in the rolling over of non-investment grade corporate debt.
Yeah.
I think credit card delinquencies probably increase. But most importantly, we have the ongoing mismatch between duration mismatch between assets and liabilities of the banks. The banks are holding 6 or 8 year paper where the net present value has declined because the interest rate has declined, and they're funding that with overnight deposits where their cost of capital has gone up. The banks, if they hold those assets on the balance sheet as held to maturity, don't have to report the mark-to-market losses.
Right.
According to Zach's, if you report the mark-to-market losses, some banks as large as Bank of America are insolvent. Now, Bank of America's not gonna go broke. They're gonna be allowed to extend and pretend. And most depositors at the Bank of America will not ask the bank for a statement of financial condition, or if they do, they're not gonna read it. So we're gonna get through this. Maybe we shouldn't, but we're gonna get through it. But when I say we're gonna get through it, we're just gonna postpone it.
Right.
At some point in time, at the federal level, $150 trillion in liabilities serviced by a budget that's in deficit by $2 trillion a year, combined with the other difficulties, is going to have to be dealt with. It's going to be dealt with all at once, or it's going to be dealt with on the installment plan. The second thing that you talked about, Zach, is an unforeseen circumstance, a black swan emerging, eliminating confidence, and giving us a liquidity squeeze, aka 2008. And that scares the hell out of me because it really, truly is all about confidence. I've been, in addition to the natural resource business, I've been in the banking business all my life. Banking is a very, very, very good business if you don't get too greedy and you don't get too stupid. Unfortunately, many of my peers in banking are too greedy and too stupid. And in 2008, what happened is individual banks looked at their own balance sheet and said, oh, Christ, we're toast. And if we're toast, everybody else is toast. So no transactions took place. Liquidity completely dried up. And we came very close to losing the whole system. I don't know what the trigger for that would be. And I pray that that doesn't happen. But it's certainly a contingency, having lived through it once in my cognitive period, to prepare myself for the possibility, no matter how remote, that it appears again. Listen, I don't want your listeners to prepare their whole life waiting for this to occur. I think it probably doesn't occur. But I think you need to prepare yourself for the possibility that it does.
Yeah, and for me, when I look at the equity market, which I wanted to ask, besides mining companies, resource companies, do you have any exposure to any of these tech companies? Are you making any plays there?
I don't.
Yeah.
I, at this stage of my life, have no fear of missing out. So I only do things I understand well.
Yeah. Yeah.
I grew up in Silicon Valley. I know how smart those people are. Those are businesses that I can't pronounce, never mind understand.
Yeah. Right.
So I stick to insurance companies, banks, wealth managers, asset managers, and natural resource businesses. I stick to businesses that I understand really, really, really well. And that stood me in very good stead.
Yeah.
Money that I didn't make is not money I lost. I just didn't make it. So I stick to what I know.
Yeah, and that's how I feel. Yeah, you may have a little bit more upside. I don't really want to get in the way. I'm definitely not going to go short these companies,
Right.
but I just see valuations that make no sense. And eventually we have to come back down to some sort of reality. And even if it's not a great financial crisis type event, you're talking about a correction that I don't want to be exposed to. Like, I'm glad to watch from the sidelines. When we talk about this, we're talking about Nvidia, which is now equal to the entire Chinese stock market, which granted has collapsed about 40-50% here lately. But then you also have Microsoft, which is now worth than all of the energy sector companies in the S&P 500, even though all those energy sector companies produce way more free cash flow than Microsoft. Have you ever seen something like this in the history of your investing career, Rick?
The answer is I don't know, because I don't know what Microsoft and Nvidia are worth.
Yeah.
I would just ask your listeners who own those if they know what they're worth. I don't do things that I don't understand. So, as an example, I don't own China because I don't understand it. I don't own Nvidia because I don't understand it. I don't own Microsoft because I don't understand it. I have one general market security in my portfolio. That's Berkshire Hathaway.
Okay.
He's proven for 60 years that he does insure it. He does understand it, pardon me. And he also, because he operates that company as an insurance company, has an extraordinarily low effective tax rate. So my entire general securities portfolio is Berkshire Hathaway. Other than that, I only do what I know. And I'm not suggesting to your listeners that they do conventional financial services or extractive industries, if that's not what they know. I would only ask them before they buy NVIDIA what they think it's worth.
Yeah. Yeah.
If they don't have an opinion as to what it's worth, why on earth would they buy it, not knowing what it's worth?
Yeah, well, the good news, I think many of my listeners are passing on that one. And we've been ones that have been kind of calling out these narratives, and we just say, this doesn't make sense, right? And if it doesn't make sense, we're just going to stick to what we know. And obviously that's worked in your career. Now, speaking of that, let's talk about some opportunities. I want to talk about the commodities markets, some of these commodities in particular that you see opportunities, but this was a big takeaway for me. You mentioned when you were on stage talking about how you've made 14 investments in Ross Beatty companies. Right. And I may have my numbers slightly off, but about 14 investments in Ross Beatty companies, and almost 10 of them became 10 baggers or better. But before they became 10 baggers, you saw 50% drawdowns. So can you speak to investing during big cycles like this? And when you're choosing these companies, time-tested strategies that you found, and then picking operators like Ross Beatty that are just winners. Can you speak on that?
Yeah, that's a great question, because there's 3 points. The first thing is, if you're speculating, if you're buying small companies, people, 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 and people. Ross Beatty is a superior human being. He's had 14 companies. 11 of them went 10 for 1. If you weren't in Ross Beatty companies and you were in that sector, mostly you got killed. Don't buy sectors. Any sector. Don't buy the mining sector. If you buy the sector, over time, you'll go broke. Don't buy the technology sector. If you buy the technology sector, over time, you get broke. Buy companies in the sector and you'll do well. And buy people in early stage companies. The second part is equally important. The average holding period of a Ross Beatty company for me to enjoy 1,000% gains was 6 years. Most speculators have trouble holding stock over a long weekend because they don't have any reason for understanding why they sold the stock. So if the stock starts to go down, rather than thinking it's becoming more cheaper, they think it's becoming worse. And the third thing is you have to be tenacious. The small stocks can inhale or exhale by 15%, up or down, for no reason whatsoever. Every one of the Ross Beatty stocks that gave me a 10-bagger, at some point in time over the 6 years I held them, caused me to experience a 50% decline. So you have to be persistent and you have to be tenacious. You have to know enough about your investments that you are confident enough to be tenacious. And the lovely thing about Ross Beatty, one of the things I like about him the most, is he's contrarian. He's countercyclical. When the price of silver is at $4 and he sees that the silver price has to go up, the fact that everybody hates it makes him love it.
Yeah.
When the price of copper falls from $2.50 to 80 cents, and Business Week magazine has a cover called The End of Mining, Ross Beatty says this is great. Copper has to go to at least $2 from 80 cents. So when nobody wants to be there, boom, he's into the copper business. You follow me? In addition from being hardworking and being brilliant, he is a simple contrarian who is willing to be 3 years early so that he can be really, really, really right.
Yeah. Yeah. And I told you how a lot of my audience, we talk about cryptocurrencies a lot. Our thesis is that about 99.99% of them go away and have no real utility. But to, duration of investments, we got the crypto space, which is probably even worse than the traditional stock trader, right? Because in the crypto space, we're not only day trading, but we're also using 100x leverage, right? And many in my community don't partake in that type of degenerate speculation. We stick to more fundamental speculation. I think kind of similar to your strategy. And I think that it's so important to understand, like you said, you're investing in a space, you're investing in companies that are hated, that are completely overlooked, and this is where you're finding value. Can you elaborate a little bit more on that?
Yeah, I think that's really important. Differently than crypto, where the utilities are either application or anonymity or frictionless trading, where in terms of durable competitive advantage around their product, there is none. Right. Where you have to evaluate them very differently. If you're looking at the exact opposite, which is to say the producer of a tangible, really, because they're capital intensive and cyclical, you have to be a contrarian. Markets work in these markets. So the cure in commodities for high prices is high prices. The cure for low prices is low prices. Specifically, to be successful as a commodity investor, you look for a commodity whose production is essential for the maintenance of our standard of living, something that will be used 5 years from now and 10 years from now, where the cost of production, the cost of producing the commodity exceeds the price it's selling for. Right. Where the industry is in liquidation, because low prices will stimulate more demand and they'll kill supply. The price will have to be up to sustain our standard of living. An example would be uranium over the last 5 years. The price of uranium got down to, as low as $12 a pound, but averaged around $20 a pound. It cost fully loaded $60 a pound to make the stuff. So the industry was making the stuff for 60, selling it for 20, losing $40 a pound and being dumb miners trying to make it up on volume. People hated the industry, but either the price went up or the lights would go off, because uranium, even in a country rich enough to believe it didn't need it like the United States, generates 20% of their base load power from uranium. So either the price went up to the level necessary to sustain production or the lights would go out. That simple. And yet, because the uranium price hadn't moved, or if it had moved, it moved down, because people were bored of it or hated it or were afraid of it because of Chernobyl or 3 Mile Island, people didn't pay attention to the simple arithmetic. Now, 3 years later, the price of the stuff is $100 a pound. It doesn't have to go up anymore. And now people are fascinated by it. Right. The simple contrarian lesson of the fact that a commodity, when arithmetically it had to increase in price, attracted few buyers. And then 3 years later, when a commodity is up fivefold and doesn't need to increase in price, it attracts a lot of buyers. Understanding that is the key to making money.
Well, and it overshot too, right? It didn't go to the $60 where they needed to break even.
Correct.
It almost doubled that, right? Over $100.
The nature of reversion to mean is, if you're under mean, you need to go over mean to make mean. That's, it's important to understand arithmetic when you're doing this. And what you say is very true. Because commodity businesses are capital intensive and cyclical, you get to incentive price, sometimes very quickly, but it can take 5 or 6 or 7 years to increase supply to meet the price signals. Similarly, when the commodity price begins to fall, because so much of the company's costs are sunk costs in terms of capital, they will produce down to and through the marginal cost of production to avoid having to shut in capacity so they can they can participate in the next bull cycle. So commodity markets always overshoot to the upside and they always overshoot to the downside.
So are we in the beginning of a commodity super cycle, or is this just a hype marketing term?
I guess it depends on your definition. I think we're coming into a 10-year period that will be marked by undersupply.
Right.
We have underinvested in productive capacities around natural resources for at least 30 years. And this is a situation that can't be righted in the near term. It simply can't be righted.
Yep.
We need to replace one Bingham Canyon, the biggest copper mine in the United States, every year to maintain current production, and we're not. We're underinvesting in the oil and gas business, $1 billion a day in sustaining capital investment. And in the capital-intensive businesses, investment deferred reduces productive capacity. So there's absolutely no way in the world, absent a really ugly recession, that we don't begin to experience real production declines. You can have a production decline in a recession when demand decreases and not move supply. But irrespective of what we do, we're going to have supply constraints in natural resources. There is absolutely, positively no doubt about that. The race is going to be between production declines and economic growth as a factor, and then technology, the efficient utilization of resources, the ability to do more with less. My suspicion is within the next 10 years, global economic growth, global demographic growth, and supply shortages will outpace the efficiencies that we achieve through technology. And the consequence of that is that commodity prices will be particularly strong, and even more particularly strong relative to other sectors in the economy, like services and technology, that have outperformed natural resources for 40 years.
Right. When we look at the equities to commodities ratio, completely out of whack from where it historically trades at. And so I think that, even if, we just correct kind of back to the average, we're talking about a significant shift back to what I call real value. Now, it's not to say that there's not real value in tech. It's just, we've heard you mention, the breadth, and we've all been talking about the breadth of the S&P 500 is not there, right? And for those who don't know what that is, that's the overall health of the index. You have magnificent seven companies that are keeping the party going while the rest are struggling. Now, let's I wanted to ask you, kind of about some of these opportunities. We've seen that uranium's already ran up here to about 100. I don't have the current price in front of me. And we have, mines that are being shut down. Actually, before I go on to that, I wanted to ask you real quick about the mines shutting down and supply constraints. I just pulled across my desk an article of the Mexican president suggesting that we need to ban open pit mining.
Yeah.
What's going on here? I see that Peru's also have production fall off. Where are we going to get the commodities from if we're not allowed to get it?
Interesting question. I mean, it might be that the Mexican people are smarter than their president. I certainly hope that's true in the United States. It's this type of thinking in Mexico, populist leftist thinking, that decimated their national oil company. Pemex's domestic production in Mexico has declined by 75% in 20 years, which is why there's such a massive hole in the Mexican government deficit. That same thinking is the kind of thinking that would shut down open pit mining in Mexico. It's worth noting that he approved as mines minister the former environment minister of Mexico, which tells you a lot about government support for mining or lack of support for mining in Mexico. But by the way, rather than look south of the border, just for fun, let's look at Arizona. Wonderful copper deposit there called Resolution. 1.5% copper. Average mine grade of copper worldwide, 0.5%. Superb deposit. along a highway, with water, with power, with communities that have miners working in them. Thus far, that mine has consumed 20 years in permitting. Maybe the Mexican president is merely honest. Maybe it's the American system that's corrupt. If you allow open pits in theory, but you don't permit them in practice, is there a difference between U.S. stupidity and Mexican stupidity?
Right.
You still don't mind.
Right. Right. Yeah. So basically you're saying that although it's quote unquote allowed here in the United States, we're going to run you through 20 years, a bunch of money, a bunch of time, and you still might not even get to production. So
Correct.
This is all adding to our thesis on this one. Now, what we're seeing is a record level of gold buying. I want to go through the commodities. So with gold, we're seeing a record level of buying. It's just been reported that the Chinese central bank added another 10 tons, 15 months of straight buying. They're finally reporting. And we even see,
girl. I'll cut later. Sorry.
And I wanted to add too, I got this data point that just came across my desk too. So the Central Bank of China has been adding for 15 months straight. They're finally reporting that and letting us know that they are acquiring. But now we're seeing that young people in China are stockpiling gold too. Ages 25 to 30 emerged as the primary consumers of gold in China, soaring from 16% to 59%. So we have central banks buying more gold than they have in 50 years. And we even have young millennials out of China and young millennials like myself that are stacking as much of this as I can afford to. And so what's the thesis right now on gold? And then we'll talk silver.
I think you're seeing foreign central banks buy gold because of the politicization of the U.S. dollar and the fact that they increasingly need mediums of exchange outside the U.S. dollar, and they don't trust each other enough to use their respective currencies, the BRICS fraud notwithstanding. You aren't seeing retail purchase of gold in Western markets, with the exception of a few adherents, including some young ones like yourself. You are seeing increased private purchases of gold in countries that have traditionally been precious metals oriented. So as an example, India, the United Arab Emirates, Pakistan, Japan, China. And for all of our problems, I think you're seeing the same current account deficits with regards to Chinese government spending. Their trade surplus is still large, but their government deficit is increasingly worrisome. So I think young Chinese people are doing the intelligent thing. They're buying gold. Interestingly, they're buying gold with official government encouragement. The government is encouraging people to save in all ways, but to save specifically in precious metals, which interests me. I am now beginning, really 3 years ago, to see an increase in interest among some young Americans in gold. But I would note statistically, sidebar, by the way, for your listeners, I've now graded about 80,000 resource portfolios in 7 years, and hence learned a lot about the way people invest. And I pay real attention to the data. And what I've learned about people in the United States, young people in the United States who are gold and silver buyers, is that they're mostly either foreign-born or first generation, which is to say the precious metals buyers that I've seen in the United States are Hispanic, or they're Arab, or they're Chinese, or they're Indian. I haven't seen a lot of Zachs in terms of young buyers, although I certainly hope to see more.
Yeah. I'm doing my part. My friends are more interested in cryptocurrencies, though. I think that the desire over here to go to alternatives, they just stop at Bitcoin and they just stop at crypto before they make it to metals. And it's just viewed as kind of this old relic of the past, and it's not really ingrained in our culture, I guess.
There's a simpler explanation. Crypto's worked for 5 years. People's expectation of the future is set by their experience in the immediate past, which is why people who don't understand the immediate past get their ass whipped so consistently. Crypto now is valuable because it's worked.
Yeah. Yeah, that's right.
Uh,
I guess our culture is rooted in watching. I call them the Bitcoin bros.
yep,
Get rich quick, relatively speaking, off of this stuff, and that's the
yep,
story and the narrative that sells so well. You're
right.
so right. Now, I want to talk. We mentioned gold there. We've finally seen gold has broke to all-time highs, and it's been holding 2,000 very well. But you mentioned earlier in your thesis that we might not see gold appreciate in kind of a correction in the equities until after this year, sometime down the road. But eventually, we are going to see it. And I heard this from you first. You're not investing in gold because you want it to go to 3,000. You're investing in it because you're scared, afraid that it's going to go to 6 to 8,000. Can you explain that thesis?
Absolutely, positively. Gold does well during periods of economic stress. Economic stress changes your lifestyle, and not for the better. I'm old and fat and rich. I don't want any change in my lifestyle.
Yeah.
I'm afraid that I'm going to experience one.
Mhm.
And the consequence of that is that there's a time-tested remedy for that, which is called gold. Most people aren't afraid. Most people are greedy because they've lived through 40 years of benign economic confinement when it didn't pay to be afraid. I'm a student of history, and I lived through the decade of the 70s. I saw what happens in a decade where the purchasing power of your savings declines by 80%. For the record, it ain't pretty. uh, so, uh, and by the way, when we talk about gold having broken out to new highs, it's important to note that those are nominal highs. If you use an inflation adjusted returns, gold is still substantially below real highs. In other currencies that haven't done well against the US dollar, gold is in fact at inflation adjusted highs too.
Mhm.
Uh, but I think the point remains. For me, gold is an insurance class. It's not a speculative class. I could care less if gold goes to $2,200 or $2,300. To be honest with you, I'd rather see it go to $1,500. I'd rather be wrong. I'd rather that the world sail on as beautifully as it sailed on for the last 40 years with no reason to doubt the efficacy of the US government. I'd rather go to my death being a cranky old libertarian complaining about Biden or Trump and not having any change to my lifestyle, which is very good, thank you. But when I look at the arithmetic around US dollar savings, that's much worse than the narrative. And so I feel the need to own gold.
Yeah. Yeah. So let's talk silver. Now, silver hasn't broken out. It's remained suppressed. Every single day, I swear that COMEX market opens up and whatever gains we got overnight in the other markets get quickly wiped out when the COMEX opens up. The question I have for you in silver, I think many of us understand the thesis. We could do a whole nother show on, how much the utility, the industrial utility, and it's still being valued as a monetary currency as well. We saw India just eating up the silver last year. And we've ran for, I think at least 3 years that I'm aware of with deficits being reported by the Silver Institute. So I guess my question as we're running out of time here would be, at what point do you think that we can break free from this suppression for silver, if ever?
Well, we could have a whole talk about suppression.
Yeah.
I don't believe that sinister forces have had to conspire to depress the price of silver because I think the silver market was taking care of itself. The dollar did well, so silver did poorly. I do believe that
Yeah.
markets are manipulated in the near term. Any market that trades 200 times the volume available for good delivery in a day is a market that's ripe to be manipulated for the short term. Uh, your original thesis or your original question about where silver will move, I'm forced to address merely by looking at history. What has happened in prior bull markets is that the precious metals narrative is established by the fear buyer, the gold buyer. And as that narrative comes to be cemented in people's mind by price appreciation, that is to say, once the markets validate the narrative and the generalist money starts to move in the space, then the more volatile metal and the metal with a lower unit value moves further and faster. In my experience, you need the gold market to be really and truly underway for a year or a year and a half before silver moves.
Right.
When leadership changes to silver, those moves traditionally have been much more dramatic.
Yeah.
Does past need to be prologue? No. Am I suspecting that in the next market past will be prologue? Yes, because I see markets being more international, and I see the lower unit price of silver making it accessible and affordable to emerging markets consumers that will also need to protect themselves against inflation, but can't afford the type of inflation offered up by gold. The point you make with regards to its increasing industrial application is important too. But in my mind, what causes the type of dramatic increase in the silver price that speculators look to is simply a change of perception among speculators. And then finally, of course, the most volatile of all asset classes isn't the silver, but rather that small population of silver stocks that's actually viable.
Yeah.
My friend Doug Casey suggests that when the generalist investor moves into the silver space, there isn't enough market capitalization to contain the money. He describes it elegantly as attempting to siphon Hoover Dam through a garden hose. I've been through a couple of these periods in my past. Crypto investors will understand the experience, but nobody else will. In the decade of the 70s, the price of Coeur d'Alene mines ran from 10 cents to $65. I didn't participate in that as a young man in 1970. I didn't have the money to speculate. But I did participate in the early 90s in the run of silver from $4 to $50, and the run in silver standard from 72 cents to $45, and Pan American from 50 cents to $40. Wonderful, wonderful experiences. You speculate in the small silver stocks, not because you know when it's going to move, because you don't. You do it because you have the financial and psychological stability to afford volatility and afford time, knowing that when the event occurs, the price appreciation that you enjoy makes any rent that you had to pay on the capital employed, the sunk capital, irrelevant.
Right.
Totally irrelevant.
Yeah, and I guess for me, my thesis, when I look at the space right now for myself, I've worked my butt off so that I could get into a position to invest in some of these private placements. And so I'm trying to learn as much as I can from gentlemen like yourself. And so I guess I'd like to ask, as we wrap up this session, could you give us one piece of advice for someone who's looking to do private placement in these companies before they go public? And really, how do we find opportunity when we go to sift through 90% of them, which aren't viable, but those 10%, which could be some life-changing opportunities?
The best investment is self-serving. Go to the rural classroom. It's free. There's no obligation. There's 200 hours of instructional programming as to how to do securities analysis on mining and oil and gas companies. The first thing you invest in is yourself.
Yeah.
The biggest risk that you face isn't inflation. It isn't Biden. It isn't Trudeau. It's to the left of your right ear and to the right of your left ear. Educating yourself enough that you don't make mistakes is critical. The second thing is to forget your time preference. Everybody wants to experience immediate gratification, but immediate gratification almost never occurs. The speculations that I have participated in that have yielded tenfold or better returns for me have uniformly taken 5 to 7 years. And prepare yourself to endure mind-numbing volatility. And beyond volatility, cyclicality. As I said at the beginning of the interview, the median of the Ross Beatty stocks that I owned exposed me to 50% declines in share price during the time I owned them. Because I knew the stocks well enough, I greeted the 50% share price decline, not by being panicked and selling, but rather by buying more. Yeah. And so the share price declines were of benefit to me, but I'm not suggesting that they weren't psychologically trying.
Yeah. Now, Rick, I don't want to keep you over our time, but I do want to ask two final questions. So first off, with your battle bank here, I want to give you a chance to say what
Sure.
you're doing here real quick. We have the first bank that's really allowing you to collateralize your gold or silver. And can you tell us what you've been working on over there?
Yeah, I need to begin by saying this is the seventh bank I've been involved in. I've been involved in the banking business a very long time. My avocation should probably be best described as used money salesman. That's what I do. The story really goes back to 1998 when a group of us started something called EverBank, which was one of the first internet-enabled bank in the United States, a bank that didn't have any branches. This, or the computer, was our branch.
Mm.
And we were able, by lowering our non-interest expenses, by not having branches, to be among the best quartile in terms of deposit interest payers in the United States, while also being extremely intelligent lenders. We grew that bank from zero to $28 billion in AUM before we sold that bank to TIAA-CREF, a big annuity issuer. Having sold the bank to TIAA-CREF, they began to introduce products that were of use to their users. They didn't need our marketing because they had 1.5 million members. So all the stuff that was cool for our customers, and we added 275,000 of them in 14 years, began to fall by the wayside in favor of products that were useful to retired teachers who TIAA services, which means that our community base, our 275,000 customers, were effectively left orphaned. So when the golden handcuffs came off our team of bankers that had been sold, we decided to form a new bank. What's our value proposition? Well, the first part of the value proposition is that we will be in the top quartile in interest payers nationwide, and we will pay you interest on your checking account. We're not going to give you 14 different accounts, most of which don't pay you interest. We're going to give you one account. You want to write checks? God bless, write checks. The second thing that we'll do is we will allow you to make federally insured deposits in 22 currencies worldwide. If you don't want all your money in US dollars, or if you're a foreign business person doing business in the US in Hong Kong dollars and the US dollars, you'll be able to bank in both. That's very important. Additionally, Zach, we believe that your IRA is your IRA. Most IRAs are receptacles for investment products from the sponsors. In your IRA with Battle Bank, you'll be allowed to own rental residential real estate. You'll be allowed to buy franchises. Your IRA will be your IRA. And finally, what I'm really excited about is that there are $33 billion in precious metals deposits in segregated accounts in the United States, and they have no bank. If you are banking in precious metals, but you have a cash need, and you don't want to sell your gold or silver, you want to put a down payment on a duplex, you want to put a down payment on a rental house, you want to pay a kid's college tuition, that gold to us, provided it's a segregated account, not buried in your backyard, is good collateral, and we'll lend it against it. The idea that none of my banking competitors seem to believe that a highly liquid asset in control of the lender isn't good collateral is beyond my ability to comprehend, but I'm delighted that it's so. So any of your listeners who aren't satisfied with their current bank, I suspect that means all of them, who would like to deposit with or borrow from a sanity-based bank, are invited to go to my website, Rural Investment Media. In the question and comment section, click bank, or go to battlebank.com.
Yeah, I would encourage all of our listeners to get in touch with your platform and all the content that you're putting out. Like you mentioned, you have the classroom as well, Rural Investment Media. You've been doing many interviews. And then at the forefront of really building out this new financial system, which is why I saved, obviously we only got to talk about the Battle Bank here for 1 second, but it leads into my last and final question, which is, how does this, are we about to see a new financial system that's created? I think that you're a prime example of offering products and services that the traditional system and bank just isn't interested in. We find, for me, it's an opportunity with utilizing distributed ledger technology to, you use commodity backing for currencies, for assets, for deals, to bring these countries kind of more on a level playing field, right? And the ability to trade in neutral, frictionless systems outside of the US dollar obviously is appealing many. And then the ability to use gold, silver as a reserve hedge, but then also use it to get collateralized, loans and, services and product offerings like this. So, any thoughts on kind of this new financial system that's being created? And obviously you're at the forefront of it, so I commend you on that. But how do you see this playing out?
To the extent that the political forces allow the people to use the distributed ledger, the game changes finally and completely. Now, pay attention to the fact that most of the financial products that come out of the distributed ledger will be scams. Zero doubt. Most people don't spend the time and attention to understand whether or not a gold-backed currency has gold backing it, as an example. And so the technology is only as useful as the institution that stands behind the technology. Right. The ability to have a token or a coin that represents fractional physical ownership of a material that exists in a storage facility that you trust and have access to facilitating delivery changes everything. Yeah. Now, there will be some massive central frauds too. The central bank digital currency is securities fraud on high. The idea that the authorities could issue a currency in conjunction with the social credit score and then cancel your currency if you ate too many donuts or voted for the wrong party is something too horrible to contemplate. But it's the other side of that distributed ledger technology. I personally am less interested in cryptocurrencies because I don't understand them. Yeah. And I'm more interested in the application of the distributed ledger in disrupting conventional financial services. Yeah. Possibly because I understand so well the need for those incumbent financial services organizations to be disrupted.
Yeah. Well said, Rick. Well, it's been an absolute pleasure. You're a wealth of knowledge on so many things, obviously going through the macro situation, covering the U.S. economy, and then honing on some opportunities and commodities. I tell you what, for me, I'm ready to go to your website myself and go learn some more. So I do want to encourage all of our listeners to go to ruralinvestmentmedia.com. You got your battle bank as well. You got the classroom. Is there anything else that we should mention before we end this one, Rick?
Yeah, if you like what I have to say about natural resources and you own some natural resource stocks, go to Rural Investment Media. List your natural resource stocks. I'll personally rank them 1 to 10, 1 being best, 10 being worst. No charge, no obligation. I'll comment on individual issues if I think my comments might have value. While you're there, if you care about Battle Bank in the question and comment section, just write bank.
But don't ask for any crypto valuations, right? You don't look at any crypto, right?
Ask Zach for crypto. Okay. Ask me for the old school.
Well, my audience knows how I feel, which is probably the same as you, which is 99.99% of it goes away. And it's all about utility for us as well. So, Rick, it's been an absolute pleasure. I'm just so glad that I can continue learning from you. And we'll make sure to plug all your links down below, folks. Make sure you guys go check out Rick. And thank you for coming on the show today. It's been an absolute pleasure.
Pleasure. Thank you for having me.
Thank you, everyone. On the way out, if you guys could like the video, make sure you subscribe, hit that notification bell, and we will see you guys in the next one. Thank you so much. I am your host, Zach Rector. I really appreciate all of the love and support. If you want to support the channel, just remember that you can start by smashing that thumbs up for me, sharing this content far and wide, and everything else is at my website.